Did you know that ETFs are a close cousin to mutual funds? In our previous video about mutual funds, we journeyed through the world of mutual funds. But, there exists a parallel universe too, in the form of exchange-traded funds. Let's zoom in to know more with my FinHub.
Ever wondered what exchange-traded funds are and how they work? Imagine walking into a store to buy fruits. Instead of choosing each fruit individually, you pick up a pre-packed basket that contains a variety of fruits, including apples, oranges, and bananas. This is similar to how an exchange-traded fund, or ETF, works. An ETF is a type of investment fund and exchange-traded product, traded on stock exchanges much like individual stocks. It holds assets such as stocks, bonds, or commodities. This is where it gets interesting. Instead of buying shares of individual companies, you buy shares of an ETF, which in turn owns a diversified portfolio of assets. This allows you to diversify your investments without having to buy each asset individually. So, just like buying a basket of mixed fruits at the store, an ETF provides you with a variety of investments in a single purchase. So, an ETF is like a basket containing different types of fruits, or in this case, different types of investments. Now you might ask, why should you consider ETFs? Well, ETFs are a great way to diversify your investments. Instead of buying individual stocks or bonds, you're buying a basket of them, spreading the risk. Plus, ETFs generally have lower expense ratios than mutual funds, which means more money in your pocket. And let's not forget the flexibility. ETFs are traded just like stocks, giving you the freedom to buy and sell throughout the day. So with ETFs, you get a diverse portfolio, flexibility, and potentially lower costs. But how do ETFs compare to mutual funds? That's what we're about to delve into. The trading mechanism of ETFs and mutual funds is the first point of differentiation. ETFs can be traded throughout the day, just like stocks, allowing for real-time pricing. Mutual funds, on the other hand, are bought and sold at the end of the trading day at the net asset value price. Next, let's consider the management style. ETFs are typically passively managed, tracking a specific index, which often results in lower expense ratios. Mutual funds, conversely, are commonly actively managed, which can lead to higher fees. The minimum investment for ETFs is generally lower than that of mutual funds, making ETFs a more affordable option for many. They also tend to be more tax efficient due to the unique way they're structured. So, while both ETFs and mutual funds have their benefits, ETFs offer more flexibility and potentially lower costs. To recap, exchange-traded funds, or ETFs, are a diverse portfolio traded on stock exchanges. They offer a passive investment strategy with great liquidity and flexibility. When compared to mutual funds, ETFs stand out in their trading mechanism, management style, minimum investment, expense ratios, tax efficiency, and flexibility. So, from India to the UK and the USA, some of the highest capitalization ETFs are making waves in the investment world. So next time you think about investing, consider the flexible and potentially cost-effective option of exchange-traded funds.
Which country are you watching this video from? What's more popular choice over there? Mutual funds or exchange-traded funds? Let us know in the comments. See you in the next video. Cheers.